Warren Buffett is considered by many people to be the most successful investor of all time and has built his company Berkshire Hathaway into a giant conglomerate worth over $500 billion as of today. So Buffett is someone who has lived through many bull and bear markets and has stuck to the same core strategy consisting of several key rules that's helped him to become as successful as he is today. So with the stock market today entering a bear market territory with the potential of a full-on crash in the future, I'm going to be looking today at what we can take away from Buffett's strategy to make us as successful as possible when it comes to investing during a stock market crash. So rule number 1 is to buy when there is peak fear in the market. So Buffett is quoted to have said, "We have usually made our best purchases when apprehensions about some macro event were at a peak. Fear is the foe of the faddist, but the friend of the fundamentalist," and that was in 1994. He's also said, "We put a lot of money to work during the chaos of the last 2 years. It's been an ideal period for investors. The climate of fear is their best friend. Those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance," and that was in 2009. So Buffett has mentioned numerous times in the past that the best opportunities to make a lot of money in the stock market do come from when there is high amounts of fear in the market, with these 2 quotes being just a couple of examples. So stock markets do tend to get overbought and overvalued from time to time, and this can typically happen right before there is a crash. However, it does also work both ways as well. And when there is a stock market crash, things do tend to actually get oversold, making stock prices particularly attractive in these sort of periods. And it is for this reason that Buffett thinks it's important to keep a level head when things reach rock bottom in the stock market and to put your money to work in these times, as this is where the most money can be made. So following on from this, rule number 2 is to always keep some cash available on the side. So Buffett has famously been quite heavy in cash over the last few years or so, and has only recently started to deploy the large pool of cash that he's been holding back and saving for moments like this. So he's quoted to have said, "A flash crash or some other extreme market fluctuation can't hurt an investor any more than an erratic and mouthy neighbour can hurt my farm investment. Indeed, tumbling markets can be helpful to the true investor if he has cash available when prices get far out of line with values. The climate of fear is your friend when investing," and that was in 2013. So this is just an example of a quote where Buffett has emphasised the importance of having cash available at all times to make the most of these opportunities in the market. So many inexperienced investors over the last couple of years were putting every penny into the stock market as it continued to go up and up every month. And looking at forums and also in the YouTube comments, you can see that a lot of people were talking about how they were waiting for their payday every month to put more money into the market. And there are even some people that were taking it a step further than this and actually taking out margin loans to essentially buy stocks on leverage. So without having any cash available for times like this, where the stock market is down quite a bit and stocks are more attractive compared to what they were before, these investors that put everything into the stock market already don't have the ability to average down on their positions and to take advantage of the opportunity that is in front of them. And Buffett, on the other hand, knows that by having cash on the side, he can't lose money aside from inflation, and it is always there for him when the stock market does dip and valuations get really attractive. So the third rule is to not try to time the market. So Buffett is quoted to have said, "Occasional outbreaks of those 2 super contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics will be unpredictable. We simply attempt to be fearful when others are greedy and to be greedy when others are fearful," and this was in 1986. So Buffett knows that markets are unpredictable and it's therefore hard to know exactly where the market is going to head in the short term, and then because of this, Buffett does not try to actually time his market buys. In general, for most investors, trying to time the market is not a good idea, and many investors have been burned over recent history by trying to do this, as they have missed out on large gains while they've sat on the sideline. It's usually a better idea to simply dollar cost average over a long period of time, and this is much simpler and performs better than trying to constantly sell out and buy back into the market. In April 2020, for example, when the market had a sharp recovery from the pandemic lows, there were some investors that sat on the sidelines, completely out of the market, anticipating that the market would go back down thinking that this surge that the market was showing when it started to recover was simply a dead cat bounce. And by doing this and trying to anticipate the market going lower in order to get a better entry price, these investors either missed out on the entire bull run that took place throughout the end of 2020, or they would have to buy back into the market at a later date for a much higher price than what they could have done before. So the fourth rule is to simply stay away from the stock market if you can't handle the volatility. So Buffett has emphasized that to those investors who can't handle the volatility that comes with the stock market, they are simply better to stay away from it. And he's quoted to have said, "Some people are more subject to fear than others. It's like a virus. It strikes people with much greater ferocity than others. Some people can handle it psychologically. If you can't, then you really shouldn't own stocks because you're going to buy and sell at the wrong time." And he said this in 2020. So some people are more emotional than others, and also different people have different risk tolerance levels. So if you are someone who is prone to making rash decisions based on high emotion rather than logical thinking, then you're probably more likely to panic sell your stocks at the bottom of the market. And then on top of this, if being invested in the market makes you lay awake at night worrying and concerned, then it's probably better to exit the market and to consider other options to put your money into. So Buffett hasn't specified alternative low-risk options. However, keeping your money in cash products like a high interest rate savings account may be a safer option that is better for you. Alternatively, real estate or bonds could be a better asset for these people because they do tend to be a little bit lower risk compared to owning individual stocks. And then the fifth rule is to make sure you buy high-quality businesses. So during hard times where the stock market is crashing and economic conditions are poor, some companies won't make it through this period. And we've seen this especially during the 2001 tech bubble, where lots of speculative internet companies went bust in the years following the crash. And this is why Buffett advocates for owning high-quality businesses that tick the box for most of, if not all, of the following criteria. And this is, they are in a growing economy or industry, they enjoy a consumer monopoly, they cannot be vulnerable to competition, their earnings are on an upwards trend, they have a low debt-to-equity ratio, they have a high return on invested capital, their maintenance costs and capital expenditure requirements are not too high, they have a history of retaining earnings for reinvesting in growth, their management has a good track record, and the company must also be inflation resistant. Now looking at Berkshire Hathaway's portfolio, we can definitely see that Buffett has allocated a high percentage of total capital into very high quality businesses with great fundamentals. So as per the latest 13F filing for Berkshire Hathaway, Apple makes up a whopping 42.8% of the portfolio, and you could definitely argue that Apple is the single best company in the world with the best fundamentals. Their ecosystem spans across many sectors and markets, and many of which they have quite big moats in these sectors. They also make high quality sticky products that consumers love so much that it's hard for them to move away from Apple to a rival company. They also are a company that are growing their revenues and profit consistently every year, generating a positive free cash flow, some of which is redistributed as a dividend to investors, and this dividend is growing every year. And Apple also has a low amount of debt and a ton of cash on their balance sheet. And then if we take a look at some of the other top holdings in Berkshire Hathaway's portfolio, we have Bank of America, American Express, Chevron, and Coca-Cola. So all of these companies are household names and they are one of the major players in the sector that they operate in. So these blue chip companies do tend to be more stable and less prone to significant declines in stock price, and they therefore tend to perform better during a stock market drawdown compared to more speculative growth stocks. So that was 5 core principles and rules that Warren Buffett tends to stick to when it comes to investing and navigating stock market drawdowns and crashes. Personally, I admire Warren Buffett very much. He's obviously one of the most successful investors that we've ever seen. And I personally try to look at what he's doing and how he navigates certain markets and try to personally apply a lot of what he does to my own investing. But with that being said, all of the content in today's video is purely based on my own research and opinions. It's not financial advice. I'm not a financial advisor, and this video is for purely entertainment purposes only. But with that being said, guys, if you did enjoy the video or found it useful, please be sure to leave a like, as that does help out a lot. Also be sure to drop me a comment, let me know what your favourite rule was that Warren Buffett does stick to. Also be sure to subscribe if you want to see similar videos to this in the future. And apart from that, guys, thanks a lot for watching.